Today I'm going to tell you about a high-quality dividend growth stock that is selling at a steep discount right now. Why would a great stock's price be cheap? Because the price has been stagnant for a couple of years while its earnings have been climbing. It doesn't always make sense, but every so often Mr. Market presents us with exactly this kind of opportunity. Hi, I'm Dave Van Knapp for the Dividends and Income channel. Before I get going, let me ask that if you like this content, please click the thumbs up button, subscribe to the channel, and ring the bell to get notifications when we issue new videos. Okay, let's talk first about this company's quality. On my Quality Snapshot scoring system, this company is in rare territory. It scores the highest grade on all 5 factors. You can see the factors on this display. I get them from sources that I've come to know and trust over the years. The first 2 come from Valuation. They have a grade called their safety grade, which speaks to the stability of the business and generally to the stability of the stock's price. That gets a score of 1 from them, which is their highest score. The next category over, also from Valuation, is their financial strength grade. That gets an A++, which is also their highest grade. The third one over is the company's credit rating from Standard & Poor's. That is AA-. I give anything on the credit score in either the AAA or AA categories the highest. I consider that to be the highest tier, so it gets my highest score. Morningstar does a Moat rating. I hope you all know what that is. I think I've explained it already in prior videos. Morningstar awards this company a wide Moat rating, which again is the highest rating possible on their scale. And the last source I use is Simply Safe Dividends. They rate the safety of a company's dividends, and in this case, for this company, they award 99 out of 100 points. I don't think they give 100 to any company, so that's the highest score available on their system. I count 5 of my own points for each category. So you have 5 points times 5 highest grades equals total quality points here of 25. So I give this company a quality score or quality grade of A+ to signify that it's scored the absolute highest that it can on the Quality Snapshot system. Okay, let's talk about the business that I'm talking about. This company is a pharmaceutical giant. It's been around since 1891. It's headquartered in New Jersey, and it employs more than 74,000 people. It has a long list of historical advances that it's made over the years. For example, it was the first to synthesize vitamin B1 in 1936. It introduced the first pneumonia vaccine in 1977. It introduced the first commercial statin drugs in 1987. In 2020, despite the pandemic, this company grew its revenues around the world. And as you can see here, this company is perpetually profitable. This company's largest brands are shown here. You may have heard of them through TV commercials and such. I know I have. The largest brand is Keytruda, which is an injectable oncology treatment that brings in about 25% of the company's revenue. Gardasil is its second largest brand, and its third largest brand is named Januvia, which is a treatment for type 2 diabetes. Obviously, with Keytruda being responsible for 25% of the company's revenue, it's an important product. Fortunately, it has patent protection until 2028, so there's plenty of time for this company's drug pipeline to replace it in the company's product line. One last point about the company's business. It is spinning off its women's health and biosimilar divisions in just a few weeks. The deal is expected to close in June, with a new company being formed that will trade separately. Current shareholders will receive shares at the rate of 1 to 10 in the new company, and as a shareholder then of both companies, you can either keep or sell the shares in the new company. Here's the company's dividend record. You can see it has a yield of 3.3%. It's been increasing its dividends for 10 straight years. It has a 5-year dividend growth rate of about 6% a year. Earlier this year, it increased its dividend for 2021, and the increase was 6.6%. And you see again the 99 out of 100 safety score from Simply Safe Dividends. I put all that together and I get a overall dividend grade for this company of B. Just a couple of other things to say on the company's dividend record. Even though its growth streak is fairly short at 10 years, the company's been paying dividends continually since 1990, so it has a dividend paying record of 30 years. It did freeze its dividend during the financial crisis in 2008 and 2009. And also, I always like to categorize stocks by their yield and rate of dividend growth. And with a 3.3% yield and a 5-year dividend growth rate of 6% a year, that makes this stock what I would call a mid-yield, mid-growth dividend growth stock. For our final thought on this company, let's visit its attractive valuation. I value a stock using 4 different models, which I have described in previous videos. This graph from Fast Graphs shows 2 of those models. The 2 colored lines on this graph represent my first 2 fair price models. The black line is the stock's actual price, and you can see at a glance that the stock is undervalued because its price line is well below both of the fair price model lines. I've marked up this graph to highlight a couple of things. First of all, you can see the stock is in what many people call a dead money phase. That means that its price today is basically the same as it was more than 2 years ago. That's what the 4 green dots across the black price line mean. If you use the graph axis line, you can see that those 4 dots are at exactly the same level in terms of how far they are up on the graph, which indicates the stock's price at the time of each of those 4 dots. It's the same price, and it goes back 1, 2, 2.5 or so years that you've been able to buy the stock at its current price. The second thing I highlighted on this graph is the yellow highlights across the bottom. Those year by year indicate how much the stock has grown its earnings each year. We also saw the earnings growth on the earlier earnings per share graph that I displayed. So you put those 2 things together, and what it means is that this company's price today is basically the same as it was more than 2 years ago, even though it's been increasing its earnings every year. I'm going to let you in on a secret now. I might call this a pro tip, but I'm not a pro, so I'll just call it a little secret among us individual investors. That combination of flat price at the same time for an extended period of time when the company's earnings per share is growing is one of my favorite scenarios in which to buy a stock. I've seen it pay off time and time again. In this case, for this company, that combination of flat price while earnings are rising has caused the stock's price to earnings ratio to contract from 18.4 in late 2018 to just 12.7 today. Here's my table summarizing this company's valuation. It shows the 4 models, which I won't go into detail on. The first 2 are the ones that were illustrated by the graph that I just had up on the screen. The average of the 4 models ends up indicating that the stock is, in my opinion, and valuations are as much art as they are science, in my opinion, the stock is 18% undervalued right now. I will get into actual prices after I reveal the name of the company, which is right now. Have you guessed it? It's Merck, ticker symbol MRK. Here's how I see Merck's pricing. We just saw that Merck is 18% undervalued. What does that mean in dollars? Converting it to dollars, here's how it looks. Its current price is around $78. In my opinion, its fair price is $95, and I would pay, given the very high quality of Merck, I would pay 10% over $95 if I had to. But none of us has to right now because it's so far undervalued. I give it a valuation grade of B+. That would be an A if it was 20% undervalued, but I just figured it out at 18% under. But anyway, This is a discounted price for an excellent company. My last display is Merck's overall grade as a dividend growth investment. I give it a B+. We saw that in its individual categories, Merck got an A+ on company quality, a B on its dividend record, and B+ on valuation. Overall, I combine those grades with the other information we've talked about to give Merck a final grade of B+ as a dividend growth investment. And we've seen that it's selling at a steep discount. I'm not the only one that's high on Merck as an investment right now. I'm going to wrap up this video by displaying ratings on Merck from a variety of different sources. I got these ratings from the research summary that Schwab provides to its customers. And as you can see, all of the ratings except one have Merck in the top or second from top tier on each provider's rating system. And that's a wrap for May's high quality dividend growth stock of the month. Remember to click those buttons, and I'll be back in about a week with my dividend growth reinvestment for May. Bye, everybody.